right. Good afternoon, everyone. Chris Lester here. I'm going to be your presenter. I want to say hello to all of you that know me, clients of mine, people that have been on here in the past. If you know me, you know I'm a Navy vet. I like to start on time. Today, we got a little bit more content than normal because we're going to do a little bit of forecasting so we can sort of just give you our perspective of what we see on the horizon. And we're calling this Whispers of a Recession. And the first thing is understanding, what does a recession mean? Are we heading into a recession? There's different definitions. They've changed the term over time, but the Reader's Digest version is really, it's just 2 consecutive quarters of negative GDP. And we had that in Q1 of Q2. However, we've had a positive Q3. So what does that mean? Although the year has been, from a GDP standpoint, positive 2.6%, there's a lot of troubling signs on the horizon. I basically would make the statement that we're basically treading water right here. There's a lot of uncertainty in the landscape. You have global and geopolitical risk, right? Sovereign risk. We have the elections here in 2 weeks, right? So here in the US, there's some things that can definitely cause the economy here to stumble. And I'm going to give you my opinion along the way. So some of the things that I watch are housing starts, right? They've been on a downward trajectory, July and August. If people are not buying homes, either they got too expensive, but really the catalyst has been the Fed's aggressive posture on trying to stem inflation. And so because of that, the cost to borrow now has increased, and that's caused things to slow down. And when people aren't buying houses, they're not buying all the things that go along with houses and the services with it. So that's one of the areas I watch. I also watch unemployment, which was down to about 3.5%. And you can say, oh, well, unemployment's low. And a lot of politicians will tout that statistic. However, I've started to hear grumblings along the way that layoffs may be on the horizons. And when corporations are starting to feel pressed, right? So if we're taking industries and commodities, gasoline, things that need to be transported, that just has a trickle-down effect. And if companies are not selling as much, if companies are not able to move as much product, ultimately, we could see layoffs. Now, a lot of folks that I deal with haven't necessarily been through periods of time where, pink slips were given out. I remember when I was younger, my mom had worked at AT&T and my dad was working at Coca-Cola, and seeing, companies start to hand out pink slips, right? It's been a while since companies have had to take those measures. And I think that sense of complacency has caused a lot of people to think, oh, it'll bounce back. Hey, I hope that it does. But a lot of the indicators are causing me pause. So I personally believe that we are on the brink of a global recession, right? It doesn't mean that the sky is falling, but we can take defensive postures. But key indicators that I've started to look at are the housing, as I started to talk about, unemployment, although low. I think, like I said, when I start hearing the word layoff starting to be tossed around, right? Lost my job, right? As I start to deal with the client, I had a client I just met with on Monday that was notified, actually 2 clients that were notified that by December, they will no longer have a position. That starts to cause me pause. Then what happens as a natural sort of knee-jerk reaction by consumers is they tend to spend less. They're not going to travel as much. They're not going to go on vacations. They're going to tighten up their wallets. That then leads to consumer spending reductions and or running up things on consumer debt. These are all things that I watch. And that's why I think that in the next 24 months, we can start to see that. I'm going to give you some supporting data here in a bit, but I just wanted you to understand, I wanted to answer that question. Whispers of a recession. Trust your eyes, trust your instincts. What are you seeing firsthand in your household? And then how are you going to defend against it? So how might a recession affect you? So you could get laid off from work. We talked about that. But, common sense tells us if things become more expensive, daily living, your food, electricity, fuel, clothing, healthcare, comfort, all these things that we need to maintain a lifestyle, if they cost more, then therefore there's less to go around to other industries. So we therefore have less discretionary income to go on planned travel as indicated. The other thing is when we need to fix things, whether it be our home, whether it be our car, whether it be a piece of equipment, right? We could also be finding that we don't really have that money, and that's where we start to run up debt. And then lastly, stress can cause you illness and sickness. I've seen that firsthand. People start to get really, really worried. And I do believe worry causes illness and sickness. So we have to do what we can to make sure that we're exercising, that we're keeping our heads clear, that we're moving forward as we enter into this unknown charted territory. So this is the charts that I've shown in the past, and then I got a little bit more data after this. Now, if you've not been on this call before, basically these are different indices. This is the equities market, and this is a rear view mirror capture of data from last month. And as you can see, all indices, and again, 1 month does not a market make, but all indices are down, right? So I could say, hey, 1 month of data, that's not really pressing. So I'm not going to spend a lot of time on this slide, just in the spirit of time. But the next slide is a snapshot of the year of 2022, right? Up until September. And as you can see, all the equity markets, except for commodities, which actually have started on a downward trend as well, are down. And I put a gold arrow next to two areas. And this is why I think a global recession is on the horizon, because it's not just the United States. The neon green there, that is developed countries. That's equities in, we'll call that Europe, right? So Europe, you'll hear that on the news pretty regularly, is starting to feel the pressure. And then neon pink, hot pink there, that's undeveloped countries. And I typically refer to that as like China, Asia, things of that nature. So you have just a large part of the globe, right, feeling this pressure. And as you just sit back and you look at it, it's not just the US. And as you start to see that, people are looking for places to put their money, and what they're starting to watch is an evaporation of their accounts, because even though they're diversified, these accounts are all under pressure across the globe. So this chart here is a bull bear indicator. And, we had a red line earlier this year. And you can see that sort of tail off, right? That as we're on this downward trajectory, and if you go to the left, and I don't know if you can see my little mouse here, if you go to the left to the last red, when the COVID hit, part of our advice was, hey, listen, this is probably our read is it's going to be a V. It's going to be a quick recovery. And a lot of our clients, we had them remain in the market. However, we're starting to give advice to take a defensive posture. Not only have we been doing that for probably a decade to be careful of bonds, but now even on the equity side, we have to start to think about, hey, if this market has still another 20 or 30% downward pressure, what is the correct place to be? And that is really what the purpose of this call is, right? I'm not giving a catch-all blanket statement, but we have to be aware that we're probably going to continue to feel pressure on a go-forward basis. And that's on the equity side. Now we're going to turn around and look at the same type of data on the income side, right? So if you've entered into retirement, you're planning on following a fixed income type of strategy, again, the month of September was not good for the income arena. And again, 1 month does not a market make. So if I turn around and I look at the snapshot of the year, you'll see that I put the arrow next to the neon green and the purple. And that, again, dictates really Europe for bond holdings and the US aggregate bond market. They're both down 12, 13, 14%. So if they're down and you entered into retirement and you were counting on this income from your portfolio, this is why we've been cautioning it for, like I said, for a long time, that bonds don't like rising interest rates. Well, we've seen now the Fed has gotten very aggressive this year in an effort to stem inflation. Interest rates have been going up and quickly, right? So again, what is the solution? And there's not necessarily a solution more than there is an awareness, right? I'm never been a fan of panic, but we need to start to take strategic steps to say, what can we do? Are there strategies we can put in place to sort of maybe not go backwards. And I can tell you that I myself personally do have strategies that we typically like to put in place that you have a balanced portfolio. But if it's in your 401k at work, you could be in for a rocky road here in the near future, because a lot of those things that are available in those corporate type retirement plans don't necessarily have brakes on them. All right, so lastly, this is the chart. And as you can see, that red line, after decades of an upward trend, a 40-year, what we call a secular bull bond market, upward trend has rolled over. And now it started on this downward path. And, again, if a portfolio, it's not that we're not going to get more yield, and you'll see that in a couple of slides on, as the Fed starts to raise interest rates, as long-term bond rates start to increase, right, the opportunity to make more money on that will come, right? But the actual value, if you're in either own the bond specifically or you're in a bond fund, and they can lose value, and hence the risk, which is why I've cautioned against this for quite a while. And, I'm not sitting here patting myself on the back and saying, hey, I was right. But this is, again, the data was supporting what is now happening and transpiring. So the last part is, this is a recession probability analytic tool that Formula Folios created. And, I had the orange line at the 50 percentile. So this, again, sort of confirms that a recession is upon us. Now, it's not as deep as maybe that we've seen in the past, but the key word there is yet, right? So we are above 50. It just, like I said, I do see storm clouds on the horizon. It did bounce above this back when COVID was hitting, and then it dropped back, and you can see it pretty much was right around that 25 or 30 number for a while, and then it started to creep up in 2022. So, we are watching. I am going to caution a lot of you to, if you're in a 401k, you're planning on working, continue to dollar cost average into the market. That is key. If you are starting to enter into retirement, reducing your exposure to equities and bonds with some type of plan. You can't just sit on the sidelines, because there's been a number of studies, but I have a slide that I'm going to start to show that, investors that try and time the market, if you miss the 10 best days, right, you end up leaving a significant amount of that recapture on the table. All right, so here's a little bit of the forecasting, right? The fourth quarter market outlook. And what we're going to see is that the equity market, if you were to have a 60-40 portfolio, right, that right now that portfolio has experienced one of the worst downward pressures, three-quarter performance in the last 100 years. Right. So 2022 is no mystery about it, that it's been a rough year. But what makes this interesting is that not only is the stock portion of this, which happens from time to time, right? Equities are going to go down, right? So we know that that's part of risk. That's part of, as we look at this. But what's interesting is typically in the past, when you have that balanced portfolio, bonds were a safe haven. But you'll see here that the bond portfolio, the aggregate bond portfolio, is also down. And that's what makes it unique. So the recovery of this, when and where, you're going to have a lot of people with a lot of different opinion, and a lot of what I'm giving you is my opinion based on my experiences and the whispers that I'm hearing from the financial institutions. But here's why this is happening: is because the Fed is, in an effort to curb inflation, is tightening or increasing the borrowing rates, because remember, bonds have an inverse relationship to rising interest rates. So if they turn around and tighten it, markets be damned, they're looking to curb inflation, right? It is not good political theater to be able to turn around and say, hey, we're in a very high inflationary period, the highest that we've been in a decade, as a matter of fact. So these rates are projected to be as high as 4.5% by the end of the year, beginning of the first quarter. And that being said, the reason that this has happened, where both the equities and the bonds are going down, is because it's happening faster than it's happened in the past, right? So our history of the US dollars, right, is that how this has an effect globally is that, the dollar was rallying, right, globally. But now in the last month, it started to come back, and which is why you've seen in the last week, actually, the equities have started to go up. And you're like, wait a second, I'm confused. Why are equities on this tear of late? And that is because the dollar is softening globally, which actually works to the equity market's benefit here in the United States. But the dollar basically is negatively correlated with every major asset class across the globe. So what happens is they have an inverse relationship as well. And because they're negatively correlated, now that it's fallen back this week, we're seeing this volatility that we've been talking about. It's like one day it's negative. So the dollar's strong overseas, and people are saying, hey, I want to put money in the dollar, and then turn around, the US economy falls flat, and they turn around and say, hey, you know what, the dollar's not the place to be. So this is, I know it's like a Rubik's Cube, right? There's a lot of data out there, a lot of information getting pulled in different directions, but hopefully this summation is helping a little bit. But here's a little bit of a silver lining. And that is, the government is actually trying to fix some of what happened with quantitative easing with the last housing bubble burst, right? I think we all probably think and agree interest rates cannot stay at 0%, 1%. I mean, if you're curious as to what your CDs were paying in your checking account at the local bank, and remember, they were 0.25%, 0.5%, less than 1%. Well, that's long-term bonds, and that's because the government had been printing money for decades, right? So now they turn around and at the point where now, because things are going up so greatly, they're raising interest rates. In the long term, new money that enters into the bond arena will start to pay off a higher yield, and that's good for the economy long term. Now, stock valuations, you can make the case that, equities are down so far year to date, 20%. You're like, hey, now's the time to buy. Maybe. I don't have a crystal ball. I think with anything, like I said earlier, if you're in some type of traditional retirement plan at work and you can dollar cost average, continue to do so. But if you're sitting on the sidelines, is now the time to buy and you have an abundance of cash? I don't know that I would be feeling real comfortable, because like I said, I still think there's some storm clouds, and I think we could see a prolonged rough patch ahead. So this is consumer sentiment, and one of the things that this is sort of a contrary or a contrarian indicator. This basically says that, the public typically gets it wrong. So when the public feels one way, that's the time to invest. So on 10-4, we had a double dip where we were almost at all-time lows, where you can make the argument, hey, if you stepped in, we should see things start to gravitate back to the means. And again, short term, had you done that back on 10-4, now here we are, 3 weeks later, probably was a good decision. My only caution, again, I don't think we're done. And, there's nothing to say that we can't continue to hover around that lower line like we did in the late 80s and 90s. So the last one here is just saying, hey, look, you know what? We are at a point where the S&P, the bull and the bear markets are saying that, we may be rolled over, but I'm not convinced. That's me personally, which is why I said whispers of a recession. I think that until the midterms get decided, until we get a real handle on some type of crisis. I mean, you hear in the news now, our reserves for petroleum, heating oil going into the winter for the Northeast is going to be tough. I mean, we've never been through times like this. So to be able to come back and say, hey, everything's going to be rosy in the future, that's going to be fine. Well, if you can't buy heating oil because it's just flat out non-available or restricted or limited, and now your pipes freeze. I grew up where my parents' house in Edison, it was an accident, right? Because there was a draft in the wall. But I've seen busted pipes, right? I understand what the cold will do. And we want to prevent that. Just because it hasn't happened yet doesn't mean it can't happen in the future. And you can see some periods there to the left of where we are now, some extended red periods. So again, I am not a gloom and doom type of person, but I was a Boy Scout and I was taught to be prepared. So with that said, I wanted to thank everybody. I'm sorry I was out. Like I said, I've been running, talking with advisors across the country. I have my ear to the ground. listening, talking, seeing what's going on, and coming back and bringing that to all of you. So hopefully you're finding value there. But if anybody on this call, you ever have questions, if I can help, right, that's what we do. So reach out to myself, to Caitlin, Keith, Alan, anybody in my office. We're happy to help you, but there's our contact information. I want to thank all of you. Everybody have a great day, and I'll talk to you soon. Bye-bye.